Welcome to the deep dive. Today, we're really getting into two huge forces, twin forces, you might say, that are fundamentally reshaping, well, everything, the global economy, how we think about wealth.
Absolutely. We're talking about exponential technology growth on one hand and, these radical shifts in finance and money on the other. Big stuff.
And we're using some, frankly, very high conviction insights today. We're drawing from world-leading experts here, Cathie Wood on the disruptive tech side, and Raoul Pal on digital assets and the macro picture.
Right. Our mission really is to be your guide through their thinking. We want to distill their forecasts, look at the biggest opportunities they see coming, these new innovation platforms, the future of digital money.
And understand the core strategies they think you need to build personal wealth, especially, in a time when, as Pal puts it, traditional currency is being sort of systematically debased.
Yeah, that debasement piece is key. We need to move past just the headlines, the big numbers, and really get into the mechanics behind predictions of like tenfold returns in just 5 or 10 years.
It's a different way of thinking. The source material, it's not just aggressive, it fundamentally challenges what most people think of as safe investments or normal economic growth.
Totally. We're looking at research that suggests real GDP growth could more than double its historical average. And financial forecasts that basically say holding cash is a guaranteed loss each year.
So let's connect those dots for you. All right, let's start with that acceleration. Where is it coming from?
We really have to begin with the foundation laid out by Cathie Wood's firm, ARK Invest. They've pinpointed 5 major innovation platforms.
And these aren't just, small improvements. They see them as the engines that are going to totally transform how we work, live, everything. The structure of industry itself.
So what are they, these 5 pillars?
Okay, so their whole investment approach hinges on finding companies playing at the intersection or maybe the cross-pollination of these. Number 1, artificial intelligence, AI.
The big one right now. Absolutely central. Second, robotics and that whole automation ecosystem. Third, energy storage, think batteries, crucial for mobility, decentralized power.
Right.
Fourth, blockchain technology, which covers digital assets, crypto. And fifth, multiomic sequencing. That's the life science healthcare revolution piece.
Okay, that 5th one, multiomic sequencing. It sounds complex, maybe the most technical. We sort of skipped over the details last time. Why is it so important? What is multiomics?
Yeah, it's a bit of a mouthful, but it represents a huge shift. We're used to genomics, right? Reading the static DNA blueprint. Multiomics is dynamic. It's not just the DNA.
More than the blueprint.
Exactly. It's analyzing the RNA, that's transcriptomics, how the DNA is actually expressing itself. Then the proteins, proteomics, what the body is actually doing. And even metabolites, what's being consumed or produced. You put all those layers of data together.
So instead of just seeing a risk factor in the DNA, you see the body's real-time operation.
Precisely. And when you combine that incredibly rich, dynamic biological picture with AI's pattern recognition, you leapfrog current medicine. You move from just treating diseases after they show up to genuine predictive intervention. Personalized medicine, but on a whole new level.
So you could spot trouble way earlier.
Years earlier, potentially. Monitoring tiny changes in your proteins or RNA that signal something's going wrong long before a lump shows up or a traditional test flags it. That's why they think multiomics will create this massive deflationary wave in healthcare costs. It flips the model towards prevention.
And that idea of convergence, combining AI with these other platforms, seems critical. AI plus multiomics changes healthcare. AI plus robotics changes manufacturing, services.
That's the core thesis, the synergy. And that synergy is where the almost unbelievable economic forecast comes from. Let's quantify that growth again.
Okay.
If you look back, historically, real GDP growth, say, since the Industrial Revolution, it's averaged around 3.0% per year. Pretty stable for over a century. That's our baseline.
Right, the world we're used to.
But based on the deflationary power, the efficiency gains from these 5 platforms converging, Wood's team projects real GDP growth could accelerate to, wait for it, 7.3% annually over the next 5 years.
7.3%. That's massive. More than double the historical rate.
It is. And if that happens, it signals not just huge wealth generation, but a complete restructuring of where economic opportunity lies. It means massive capital shifts and, crucially, massive job creation, but...
Only for those ready for it.
Exactly. Only for the sectors and the people who are, as they put it, on the right side of change.
Now, that 7.3% number, it's definitely an outlier. Traditional economists would probably push back, right? They'd point to things like regulations or maybe diminishing returns kicking in. How does Wood's team counter that skepticism?
That's a fair challenge. The standard view is, look, big economies just don't suddenly double their productivity growth like that. But the ARK counterargument focuses intensely on the exponential cost declines in the core technologies.
Like Moore's Law, but broader.
Broader and faster in many cases. The cost to sequence a genome plummeting. The cost per kilowatt hour of battery storage dropping like a rock. Computation costs, same story. These cost declines are happening way faster than traditional models account for. It's this extreme deflationary force, they argue, that injects so much efficiency it can actually overcome the usual friction points like regulation or even demographic headwinds.
Which leads to this idea that our investment philosophy needs a radical rethink. I found the example they used about Apple really interesting. Apple, seen by many as the ultimate safe tech stock. Why flag it as potentially vulnerable?
Well, it comes back to that right side of change idea. Apple's a massively successful cash-generating machine, yes, but its growth has slowed. It's relying on a hardware cycle, the iPhone, that's becoming increasingly mature, maybe even commoditized at the core level.
So it's a cash cow, not a disruptor anymore.
That's the argument. Is it using its massive resources to lead the next wave of truly disruptive deflationary innovation? The sources argue maybe not. Look at mobility. The next big personal computing platform is arguably the autonomous vehicle, not the phone. Apple tried for years to get into that space and ultimately couldn't execute effectively.
They didn't manage that cross-pollination. AI, energy storage, robotics.
Right. Their model is still largely about selling premium hardware. The future, according to this thesis, belongs to companies building scalable, AI-driven software networks where the cost of delivering the service is collapsing while the network itself grows exponentially. The emphasis has to shift from steady cash flow to disruptive potential.
Okay, let's zoom in on AI specifically. Yeah. According to Wood's firm, the biggest, most significant AI project on the planet right now isn't necessarily a large language model somewhere. It's Tesla.
That's their big convergence bet. They've put out these incredibly bullish price targets for Tesla, like $2,600 a share eventually. And they're very clear. Maybe 90% of that future value isn't from selling electric cars. It's tied directly to the robo-taxi platform.
So the key insight is Tesla isn't just a car company.
Not primarily, no. It's an AI company, a robotics company that happens to have this massive fleet of sensors on wheels generating unparalleled real-world data to train its driving AI. The cars are the data collectors for the AI network.
And the potential market size for that network, the autonomous taxi market? It's staggering.
It really is. They project it could generate somewhere between $8 to $10 trillion in global revenue within the next 5 to 10 years.
8 to 10 trillion. I mean, that's a significant chunk of the entire current global economy.
It's huge. And the disruption driving it is pure economics cost. Think about ride sharing today, Uber, Lyft. In the U.S., you're paying maybe $2, even $4 a mile.
Yeah, sounds about right.
What's the biggest chunk of that cost? The human driver. Plus, your own car sits idle 95, 96% of the time. An autonomous vehicle can operate much, much more. Take the driver out, dramatically increase the utilization of the asset, and the cost per mile just collapses.
How low are we talking?
The forecast is a potential drop to maybe 25 cents per mile once it scales.
25 cents. Compared to $4, that's like a 90% cost reduction.
Exactly. And when you slash the cost of something as fundamental as mobility by that much, you don't just substitute existing demand, you unlock enormous new demand. People will take autonomous rides for trips they wouldn't have considered before. Travel frequency goes up.
Which kind of ironically leads to another problem, right?
Oh.
More cheap travel means more cars on the road. Congestion.
Precisely. Which is why the investment thesis naturally extends into the air. That's where eVTOLs come and electric vertical takeoff and landing aircraft. Think flying taxis, basically. Companies like Archer.
So it's the next step. Autonomous mobility moving into the third dimension.
It's the logical consequence. If ground-level transport gets saturated because it's so cheap, you go vertical. And again, it's a convergence play. It needs advanced batteries, energy storage, autonomous flight systems, robotics, all coordinated by AI traffic management. The goal isn't just selling the aircraft, it's operating the autonomous network to solve urban congestion.
Okay, pushing even further out on the innovation curve. The next evolution seems to be humanoid robots. Tesla's Optimus is the big example here. This feels like the ultimate convergence. AI, robotics, energy storage, all in one package.
It absolutely is. And this is where the potential market size numbers just go stratospheric. If robo-taxis are projected at $8–10 trillion, Elon Musk and Wood's research suggests the humanoid robot market could eventually dwarf that.
Bigger than robo-taxis. How big?
The figure they throw out is a potential $26 trillion revenue market in the longer term.
26 trillion. Okay, why such a massive leap? What makes humanoid robots so much bigger than autonomous cars?
Because they're not just solving transportation, they're aiming to address the entire spectrum of human labor, potentially. The goal isn't just a robot that drives, it's a robot with human-like dexterity. Musk uses the benchmark of being able to thread a needle.
Wow.
If you achieve that, a general-purpose humanoid robot could, in theory, do almost any physical task a human can. Staff factories, provide elder care, make coffee, assist surgeons, fold laundry. It's scalable automation for basically everything.
Which inevitably brings up the big question. Jobs. Mass unemployment. That's the immediate fear, isn't it?
It is. That's the knee-jerk reaction. But the sources we're looking at present a fascinating paradox. They argue this technology isn't just a potential job displacer, it's actually becoming essential to solve a looming societal crisis.
Which is?
Demographics.
Oh.
Particularly in the developed world. We're facing a population implosion in many countries. Birth rates are falling off a cliff. You get this inverted age pyramid, fewer young workers supporting a growing number of retirees.
Right, the dependency ratio gets skewed.
Exactly. And real economic growth fundamentally requires productivity growth. If your actual pool of human labor is shrinking year after year, how do you maintain, let alone increase, productivity? The argument is only through radical automation via AI and robotics.
So wait, you're saying AI and robots aren't just coming for jobs. They're actually needed to fill a massive labor void that's opening up because of demographics.
That's the core argument. That $26 trillion market isn't just about corporate profits. It's potentially about maintaining basic economic function and living standards in countries that literally don't have enough young people to do the work anymore. This makes the push for AI and robotics almost an economic necessity, not just an option.
Okay, so if robots are filling the labor gap for many physical and repetitive tasks, what's left for humans? Where do we provide value?
The uniquely human skills remain key. Creativity, ingenuity, complex problem solving, emotional intelligence, strategic thinking, and importantly, guiding and customizing the AI itself. This leads to concepts like vibe coding.
Vibe coding. I like that term. You mentioned it's like natural language programming. Can you make that more concrete for us? What does it actually look like?
Sure. Think of it as moving away from writing code line by line in strict languages like Python or C++ would. Instead, you're instructing a powerful AI assistant. Maybe something built on models like Codex or from companies like Anthropic using descriptive natural language.
Give me an example.
Okay, instead of spending weeks coding a website, you might tell the AI, build me an online store for artisanal pottery. I want the feel to be minimalist, kind of like a Japanese Zen garden, but with a really intuitive checkout flow connected to, say, the Solana Pay system.
So the human provides the vibe, the creative direction, the specific goals, the aesthetic, and the AI handles the grunt work of writing the functional code.
Precisely. The value shifts to human insight, taste, and the ability to clearly articulate complex requirements to the AI. It democratizes creation, in a way.
And finally, circling back to AI's applications, the sources highlight healthcare as potentially the most profound area. We talked about multiomics, but then there's the convergence with CRISPR gene editing.
Right. This is where we're seeing actual revenue-generating cures emerge, not just treatments.
What are the tangible examples showing this shift?
Well, look at inherited blood diseases. Companies like CRISPR Therapeutics, working with partners like Vertex, have developed therapies using CRISPR gene editing that are essentially one-time cures for conditions like sickle cell anemia and beta thalassemia. These were previously lifelong, debilitating diseases.
A single treatment cure. That's incredible.
It is. And beyond cures, AI is crunching the vast data sets from multiomic sequencing to revolutionize diagnostics. Think about cancer. The holy grail is early detection. We're getting very close to simple blood tests using AI pattern recognition on circulating DNA or proteins that can detect many cancers at stage 1 or maybe even stage 0 before they've spread.
That changes everything for prognosis and cost.
Fundamentally, it shifts the entire economic and human burden of cancer treatment. It's a powerful example of that AI multiomics convergence, delivering real-world breakthroughs.
Okay, let's pivot now. We've talked about the incredible deflationary potential of technology. But there's this other massive force at play, highlighted strongly by Raoul Pal, the steady, relentless debasement of traditional fiat currencies. This is the economic reality check.
Yeah, Powell really focuses on the threat this poses to personal wealth accumulation, especially for younger generations. He talks about the millennial trap.
What does he mean by that?
Yeah.
Why are millennials, broadly speaking, the first generation projected to be less wealthy than their parents?
It's a combination of factors, but they're mostly symptoms of a bigger issue. You've got housing costs that have exploded relative to income, like 8x, 10x income in many places. You've got crippling student loan debt. But Powell argues the root cause isn't just high prices, it's the underlying monetary system.
Driven by debt.
Global debt, it's the sheer scale of it. He points out world debt is somewhere around 400% of world GDP. 4 times. Just paying the interest on that mountain of debt forces governments and central banks into a corner. They have to keep creating new money, injecting liquidity, essentially printing it, just to stop the whole system from seizing up or facing massive defaults.
And that continuous creation of new money, chasing roughly the same amount of goods and services, that's the definition of currency debasement.
Exactly. It's crucial to distinguish it from just price inflation, like your grocery bill going up. Debasement is the structural decline in the purchasing power of the currency itself, especially when measured against scarce assets. Your dollar, your euro, your pound just buys less stuff over time, guaranteed.
And Powell puts a number on this, a kind of baseline loss rate.
He does. He calculates what he calls the 11% hurdle rate. This is the minimum annual return your investments need to generate just to break even in real purchasing power terms.
11% just to stand still. How does he get to that number?
It's roughly broken down like this. He estimates that the sheer expansion of the money supply, I think M2 globally, relative to real economic growth, debases your cash holdings by about 8% per year on average.
Okay, 8% from the money printing itself.
Right. Then you add on top the typical inflation target that central banks aim for, usually around 2-3% for consumer prices. So 8% debasement plus 3% price inflation gets you to that 11% total erosion of purchasing power annually.
That is sobering. If you're just holding cash, you're losing 11% a year, effectively.
According to his framework, yes. And it puts traditional investments in a really harsh light. The S&P 500 historically returns around 10-11% per year on average.
So best case, you're basically treading water against this debasement.
Pretty much. You're maintaining purchasing power, maybe slightly outpacing it some years, falling behind others. It's not generating significant real wealth over the long term at that rate. And real estate.
Yeah, what about property? Isn't that the classic inflation hedge?
Powell often calls real estate a lifestyle bank. It's useful, it provides shelter, it can hedge against local inflation, and it allows you to lock in long-term debt, which is good when currency is being debased. But unless you're using significant leverage, the actual asset appreciation often struggles to consistently clear that 11% hurdle rate needed for real wealth creation.
So if cash is losing and traditional assets are just keeping pace, you need something else, something scarce, non-sovereign, and with exponential potential.
That's the conclusion, which neatly brings us back to the convergence point between Powell's macro view and Wood's tech focus, the digital asset solution, starting, of course, with Bitcoin.
And Wood's price target for Bitcoin remains one of the most talked about calls in finance, $1.5 million per Bitcoin by 2030.
It sounds completely wild, right? Like pure fantasy. Until you dig into the institutional adoption mechanics that underpin that forecast, it's not just based on hope, it's based on projected flows.
Okay, walk us through the math. How do you get from here to $1.5 million? What's the mechanism?
It boils down to institutional allocation meeting inelastic supply. The key event was the approval of the spot Bitcoin ETFs in the US. This created a regulated, easy on-ramp for huge pools of institutional capital pension funds, endowments, sovereign wealth funds, corporate treasuries pools holding trillions of dollars.
Right. They now have a compliant way to buy.
Exactly. Wood's model basically says, if these institutions allocate just a relatively small percentage of their total assets under management, say, somewhere between 5% and maybe 10% into Bitcoin as a new uncorrelated asset class for diversification,
that creates a massive wave of demand.
A tidal wave. And that wave crashes into a fixed, mathematically capped supply. There will only ever be 21 million Bitcoin. We're already near 20 million mined, only about 1 million left to come over many decades.
So huge demand, incredibly scarce supply, price has to go up to balance it.
Dramatically. The existing market cap simply isn't large enough to absorb potentially trillions of dollars of institutional inflows without the price per coin rising by multiples. The $1.5 million target isn't just a guess, it's the calculated outcome of that supply-demand shock, assuming those institutional allocation rates happen.
And this ties into Bitcoin's fundamental value propositions. Wood outlines 3 pillars, right? The first being its potential as a global monetary system. You mentioned economist Art Laffer validating this.
Yeah, that's a key point. Pillar 1, Bitcoin as a global monetary system. Art Laffer, famous for the Laffer curve, Reaganomics, he looked at Bitcoin and saw it not necessarily as replacing the dollar day-to-day, but as a superior rules-based, non-sovereign unit of account. Kind of like a digital successor to the gold standard that Nixon closed in '71. Its rules are based on math and code, not politics.
Okay, pillar 2.
Pillar 2, Bitcoin as a new asset class. This is huge. We haven't really had a fundamentally new investable asset class since equities emerged back in the 1600s. Because Bitcoin's price moves differently, it's largely uncorrelated to stocks, bonds, real estate. It offers genuine diversification benefits, essential if you're trying to beat that 11% debasement hurdle.
And the third pillar.
Pillar 3, emerging market insurance. For billions of people living in countries with unstable governments, hyperinflation, or capital controls, Bitcoin represents a potential lifeline. It's a way to store value that's hard to confiscate, hard to debase, and accessible globally. A hedge against irresponsible local policies.
Makes sense. Now, beyond Bitcoin, the thesis expands to the broader exponential digital asset ecosystem. Wood calls it the financial internet. And the core infrastructure player there seems to be Ethereum.
Yeah, if Bitcoin is digital gold, digital scarcity, then Ethereum ETH is positioned as the world computer, or the base layer for this new financial internet, Web3.
How so? What does Ethereum enable?
Smart contracts. That's the key innovation. These are bits of code that live on the blockchain and automatically execute the terms of an agreement when certain conditions are met. No intermediaries needed. This unlocks everything from decentralized finance, DeFi lending, borrowing, trading without banks, to tokenizing real-world assets, RWAs, like property or art, and trading them digitally. If you believe finance is moving onto decentralized rails, Ethereum is arguably the main operating system for that shift.
Okay, so for someone listening thinking, this sounds powerful but also complex and volatile, how should they approach investing in this space? Raoul Pal's strategy seems like a good starting point.
Pal advocates for keeping it simple, especially if you're not a full-time trader. His approach is basically concentrate your bets, put maybe 80%, even 90% of your crypto allocation into the established quality layer 1 protocols. For him, that primarily means Bitcoin and Ethereum, and he also includes Solana as a major contender.
And then just buy consistently.
Yeah, dollar cost average. Buy a fixed amount every week or every month, regardless of the price. Ride out the volatility, accumulate your position over time, focus on acquiring exposure to the network's growth, not trying to time the market perfectly.
But he also emphasizes risk management, right?
Yeah.
Given the, let's face it, insane volatility sometimes, what's the absolute cardinal rule he stresses?
He repeats it constantly. You have one job, not to lose your tokens.
Don't lose your tokens. What does that mean in practice?
It means two main things. First, absolutely no leverage. Do not borrow money to buy crypto. The volatility will wipe you out eventually. Margin calls are brutal in this market. Second, avoid chasing quick riches and super high risk, often fundamentally worthless meme coins or obscure altcoins. Stick to the quality infrastructure plays. In crypto, survival is the strategy. Patience and self-custody are key.
And one really interesting point made in the sources is about the accessibility of this particular technological revolution. Unlike, say, investing in cutting-edge AI startups.
That's a fantastic point. Most people can't invest in the next OpenAI or Anthropic before they go public. That's reserved for venture capitalists. But with crypto, the tokens themselves often represent a direct investment in the underlying network infrastructure.
So buying ETH is like buying a piece of the world computer network.
Exactly. Or buying SOL is investing in the Solana network's potential. Anyone with a smartphone and a few dollars can buy fractional ownership in these foundational protocols and potentially benefit directly from their growth as networks. That level of democratic access to investing in a major technological shift is pretty unprecedented.
Okay, let's try to tie some of these threads together with specific publicly traded companies that Cathie Wood's firm highlights as ways to get exposure to these 5 converging platforms through the traditional stock market.
Right, moving beyond just the crypto assets, their high-conviction equity picks really embody this convergence theme. Top of the list, unsurprisingly, is Tesla.
The ultimate convergence play, as you called it.
Yeah. In their view, it's not just an EV company. It's the leading public company hitting AI through autonomous driving, robotics with Optimus, and energy storage batteries. Investing in Tesla for them is a proxy bet on that whole autonomous electric future taking shape.
Okay. Then for direct exposure to the digital asset space, but via equities.
Coinbase. The rationale there is it's the largest, most globally recognized, and crucially regulatory compliant crypto exchange, especially strong in the US. Its role is evolving rapidly from just being a place for retail users to buy Bitcoin
To being the gateway for institutions.
Exactly. They're becoming the essential infrastructure provider for the big money coming in via the ETFs. They offer custody solutions, prime brokerage services, and are expanding heavily into derivatives like options and futures, which institutions need. They're effectively becoming the regulated toll bridge for the financial internet.
Makes sense. Now, in the pure AI software space, they focus on Palantir. Well, why them specifically over maybe other AI names?
Palantir's niche is interesting. They provide platform-as-a-service solutions specifically designed to help huge, complex organizations think. Governments, defense agencies, massive corporations make sense of vast, siloed data sets.
So they help legacy organizations use AI.
Right. Their software allows these big, often older entities to integrate powerful AI and data analysis without having to completely rip out and replace all their existing IT systems. They specialize in fusing disparate data sources for critical decision-making. It's AI integration for the real messy world, which is a massive market.
Okay. And for the multiomics revolution?
The primary public play there is CRISPR Therapeutics. As we discussed, they are arguably the leader in the gene editing field, using CRISPR technology. An investment there is a direct bet on that paradigm shift from treating chronic diseases to potentially curing them with single genetic interventions.
Got it. And rounding out the list, you mentioned 2 others fitting into mobility and maybe the future of work, Archer and Roblox.
Yeah, Archer is the eVTOL. Play the bet on autonomous aerial mobility becoming a reality to alleviate ground congestion. And Roblox is fascinating.
That's a gaming platform, right? How's that fit?
It's much more than just gaming now. It's a massive user-generated content platform. Millions of users, and increasingly users over 13, aren't just playing games, they're creating them. They're learning basic coding concepts, digital design, even entrepreneurship by building and monetizing their own experiences within the Roblox universe.
So it's like a training ground for vibe coding.
Kind of. It's teaching foundational skills for the next generation of digital creators and entrepreneurs who will likely interact with AI tools in very intuitive, vibe-driven ways. It's an indirect but powerful play on the future of digital work and creativity.
So pulling back to the big picture, the overall message from these sources feels like both a warning and an opportunity. Disruption is coming, like a freight train, to almost every industry.
Absolutely. Transportation, retail, finance, healthcare. If your job or your business model relies heavily on the old cost structures, the old intermediaries, the old ways of doing things, you need to pay attention. Adaptation isn't optional.
But the opportunity side is that the tools for adaptation, the potential for growth, are also unprecedented. The key differentiator, it seems, isn't just having capital, it's something else.
It's personal initiative, the willingness to learn continuously, to adapt, to experiment, to take responsibility for navigating the changes rather than just pointing fingers at inequality or external forces. The sources really emphasize this mindset shift.
An entrepreneurial shift, almost, even if you're not starting a company.
Yeah, an entrepreneurial mindset, focusing your skills and energy on these big secular trends: digitization, exponential health, decentralized communities, and finance. Finding ways to add unique human value, leveraging these new platforms, maybe targeting niches where value is less price sensitive, where ingenuity and specialized knowledge really matter. Don't try to compete with the robots on tasks they'll inevitably do better and cheaper. Compete on creativity.
So we've covered a lot of ground today. We've looked at this vision of an incredibly accelerated future, potentially 7.3% real GDP growth driven by these converging innovation platforms.
But we've also confronted the stark economic reality. Raoul Pal lays out the persistent threat of currency debasement, that maybe 11% annual loss of purchasing power in fiat, pushing us towards scarce exponential assets like Bitcoin and other key digital networks.
The clear takeaway, really, for anyone listening, has to be the need for ongoing learning and research. Cathie Wood's firm, to their credit, puts a lot of their research out publicly. Understanding why these forecasts are being made, the cost curves, the demographics, the institutional flows is critical.
Definitely. You need to grasp the underlying mechanics. But let's end with maybe a more philosophical, provocative thought that emerges from all this.
Okay, let's hear it.
If the projections are even directionally right, if humanoid robots and AI are set to generate $26 trillion in economic activity, partly by filling that demographic labor gap we talked about, if they solve fundamental problems of scarcity and the need for basic human labor.
What's left for us to do? What becomes the main point?
Exactly. If technology takes care of work as we've known it and solves the problem of material scarcity over the next, say, 10, 20, 30 years, what then becomes the primary human pursuit? What do we strive for? Is the ultimate investment the truly scarce and valuable thing in a world of technological abundance? Not actually the technology itself, but maybe what Raoul Pal often hints at. Investing in experiences, connection, community, the uniquely human elements that technology can enhance maybe, but never truly replicate or debase.
Wealth beyond measure, perhaps. Something to definitely chew on. Dive into the research, understand the mechanics, think about the future you want to build.
And we'll catch you on the next Deep Dive.